Financial reporting through the lens of a property casualty actuary. Appendix 1, Fictitious Insurance Company. Results of IRIS ratio tests for fictitious insurance company. Overview. Within this section of the appendix, we will walk through the calculation and purpose of the 13 IRIS ratios, provide possible explanations for unusual values, and show the results of the IRIS ratio calculations for fictitious insurance company using the 2018 annual statement. IRIS ratios are grouped into 4 categories: overall ratios, profitability ratios, liquidity ratios, and reserve ratios. We will present the material separately by category. It is important to note that the calculations provided herein are based on the 2017 edition of the National Association of Insurance Commissioners, NAIC, Insurance Regulatory Information System, IRIS, Ratios Manual. Further, the ranges of unusual values are as provided in the 2017 IRIS Manual. The NAIC reevaluates the reasonableness of the ranges periodically, in light of the current environment. For example, years ago, the range of usual values for IRIS Ratio 6 investment yield was between 5 and 10%. Compare that to the range in 2017 of 3% to 6.5%, which reflects the current economic environment. The current version of the IRIS manual needs to be followed when analyzing data. Overall ratios. The overall ratios focus on the insurance company's leverage in terms of premium volume relative to surplus. There are 4 overall ratios. Ratio 1, gross premiums written to policyholders' surplus. Ratio 2, net premiums written to policyholders' surplus. Ratio 3, change in net premiums written. Ratio 4, surplus aid to policyholders' surplus. IRIS ratios 1 and 2 provide written premium to surplus ratios on a gross and net of reinsurance basis, respectively. The denominator is the same in each of these ratios, with the numerator differing by the amount of ceded reinsurance premium written. The source of this data can be readily found in an insurance company's annual statement from either Part 1B of the Underwriting and Investment Exhibit, U&IE, and the balance sheet, page 3, or 5-year historical data. The purpose of IRIS ratios 1 and 2 is to identify companies that may be taking on more business and more risk than they can handle relative to their surplus. Unusual values are greater than or equal to 900% on a gross basis and 300% on a net basis. The 300% ratio on a net basis corresponds to the age-old generally accepted benchmark that insurers remain within the 3-to-1 range in terms of writings relative to surplus. This ratio is higher on a gross basis in consideration of reinsurance. The following are examples of considerations that should be made when reviewing the results of these ratios. The difference between the gross and net IRIS ratio results. Wide disparity could signal heavy reliance on reinsurance or involvement in fronting arrangements. Further investigation on the quality, rating, and collectability of the reinsurance should be made, as well as the level of collateral held, if any. This can be accomplished through a review of the note titled Reinsurance, number 23 within the Notes to Financial Statements of 2018's Annual Statement. Schedule F, and research on the financial ratings of the company's reinsurers listed in Schedule F by a recognized rating service, such as AM Best. This did not mean that a narrow difference between the gross and net IRIS ratio results should not be investigated, as it could signal inadequate levels of reinsurance protection, in particular if the company is exposed to catastrophe risk. Part 2 of the General Interrogatories provides information on a company's protection against excessive or catastrophic loss, although further inquiry would have to be made of the company for specific details. The amount of the gross premiums that stem from assumed business versus business directly written by the company. Companies tend to have less control over business assumed from third parties. Those companies having a large portion of assumed business and IRIS ratio 1 results nearing the unusual value benchmark should be subject to further investigation. This would include an understanding of the type of business assumed, attachment points, layers, and limits of coverage, as well as the underwriting and price monitoring controls in place on the assumed book. The results relative to lines of business written. Lower ratio results are preferred for companies writing long-tailed lines of business due to the uncertainty inherent in the ultimate payout of associated claims. As displayed below, IRIS ratios 1 and 2 can be calculated for Fictitious using data from the 5-year historical data exhibit. As displayed in the above table, the results of IRIS ratio 1 for Fictitious, ranging from 82% to 96% over the period 2014 to 2018, were well within the benchmark imposed for unusual values, 900%. Similarly, the results of IRIS ratio 2, ranging from 71% to 86% over the same period, were well within the 300% benchmark on a net basis. IRIS ratio 3 provides the change in net written premiums, current year over prior year, as a percentage of prior year net written premium. The source of this data can be readily found in an insurance company's annual statement from either Part 1B of the current year and prior year U&IEs or 5-year historical data. The purpose of IRIS ratio 3 is to identify companies that are growing or declining rapidly so that further investigation can be made as to the cause. Unusual values are outside of the negative 33% to plus 33% range. The following are examples of considerations that should be made when reviewing the results of IRIS ratio 3. Consistent or large increases in results. Growth brings uncertainty in the types of risks written and the frequency and ultimate cost of claims. In certain markets, it is difficult to expand without conceding on pricing and underwriting standards. Further investigation as to the source of the company's expansion and whether the company has been able to maintain adequate pricing and terms and conditions is warranted. In addition, a review of the results of other IRIS ratios can serve to mitigate or augment the uncertainty. For example, a mitigating factor would be a low result for IRIS ratios 1 and 2. Consistent or large decreases in results. A decrease in writings also requires attention. A sharp reduction in writings may be a sign of financial stress. Unstable results year over year. This may be a sign that the company does not have good controls on its underwriting or a solid business plan, and therefore raises uncertainty with respect to the viability of the company in the long term. We can also calculate IRIS ratio 3 from Fictitious's 5-year historical data exhibit. As displayed in the above table, the results of IRIS ratio 3 for Fictitious, ranging from 0% to 3% over the period 2014 through 2018, were well within the benchmark imposed for unusual values, plus or minus 33%. IRIS ratio 4 provides the ratio of surplus aid to policyholder surplus. It is meant to identify companies that rely heavily on reinsurance as a means to enhance surplus. Insurance companies typically receive a ceding commission from their reinsurers for placing business with those reinsurers. Under statutory accounting, the treatment of ceding commissions is similar to the way that an insurance company treats policy acquisition costs. The signs are just different. While acquisition expenses are a direct charge to income and surplus as they are incurred, ceding commissions are recognized as a credit to income and surplus when they are incurred. Surplus aid represents the amount of enhancement to surplus in the current period as a result of ceding commission that has been taken into income on its ceded unearned premium. Formulaically, surplus aid equals the estimated reinsurance commission rate times the unearned premium on reinsurance ceded to non-affiliates, where the estimated reinsurance commission rate equals ceding commissions from reinsurance, including contingent commissions, divided by total written premiums ceded to reinsurers, affiliates and non-affiliates. Ceding commissions from reinsurance for the current year are found in Part 3, Expenses of the U&IE of the Annual Statement, Column 2, Other Underwriting Expenses. Line 2.3, Reinsurance ceded, excluding contingent, plus line 2.6, contingent reinsurance ceded. Total written premiums ceded to reinsurers is found in Part 1B, premiums written of the U&IE of the annual statement, column 4, reinsurance ceded to affiliates, plus column 5, reinsurance ceded to non-affiliates, totals. Unearned premium on reinsurance ceded to non-affiliates is found in Schedule F, Part 3, reinsurance ceded of the annual statement, column 13, totals for the following three categories of unaffiliated reinsurers. 1. Authorized, unauthorized, and certified other U.S. unaffiliated insurers. 2. Authorized, unauthorized, and certified mandatory and voluntary pools. 3. Authorized, unauthorized, and certified other non-U.S. insurers. IRIS Ratio 4 is the ratio of surplus aid, as calculated above, to policyholder surplus. Unusual values are greater than or equal to 15%, and may be a sign that policyholder surplus is inadequate. Therefore, when IRIS Ratio 4 produces values greater than 15%, certain other IRIS ratio tests dependent upon policyholder surplus are recalculated to remove surplus aid. These are IRIS Ratio 1, gross premiums written to policyholder surplus, Ratio 2, net premiums written to policyholder surplus, Ratio 7, gross change in policyholder surplus, Ratio 10, gross agents' balances in collection to policyholder surplus, Ratio 13, estimated current reserve deficiency to policyholder surplus. Further, when IRIS Ratio 4 produced unusual values, the company's reinsurance treaties should be evaluated to assess the impact that cancellation could have on solvency. The following provides the calculation of IRIS Ratio 4 for Fictitious. As displayed in the above table, the results of IRIS Ratio 4 of 1.3% for Fictitious was well within the benchmark imposed for unusual values, greater than or equal to 15%. Profitability ratios. The profitability ratios focus on the insurance company's profitability from an operations, investment, and surplus perspective. There are 4 profitability ratios. Ratio 5, 2-year overall operating ratio. Ratio 6, investment yield. Ratio 7, gross change in policyholders' surplus. Ratio 8, change in adjusted policyholders' surplus. IRIS Ratio 5 essentially provides a company's combined ratio over a 2-year period, offset for investment income earned over that period. In IRIS Ratio 5, the combined ratio is calculated as loss and loss adjustment expense, or LAE, incurred, plus policyholder dividends incurred, divided by earned premium, plus other underwriting expenses, less other income, divided by written premium. The investment income ratio is calculated as a ratio of investment income earned divided by earned premium. The 2-year operating ratio equals the 2-year combined ratio minus the 2-year investment income ratio, where the combined ratio is equal to the sum of net loss and LAE plus dividends to policyholders incurred, all divided by net earned premium, plus quantity other underwriting expenses minus other income incurred quantity divided by net written premium. The investment income ratio equals the investment income earned divided by net earned premium. The source of this data can be readily found in an insurance company's annual statement, from the Statement of Income and Part 1B of the U&IE. The purpose of IRIS Ratio 5 is to identify companies that are operating unprofitably. A 2-year period is used in the calculation to smooth unusual fluctuations due to a bad loss or investment year. Unusual values are greater than or equal to 100%, meaning that the company is operating at an underwriting loss, even after consideration of investment income. When reviewing the result of this ratio, consideration should be made for the cause by looking at each of the components of the calculation. During the financial crisis, companies experienced a significant decline in investment income and therefore did not achieve as much of a benefit in the offset afforded in the calculation. Further, adverse development on prior accident years will have an impact on the combined ratio, but such development may not be reflective of profitability on the company's current operations or current reserving. IRIS Ratio 5 is calculated for Fictitious in the following table. As displayed above, the result of IRIS Ratio 5 for Fictitious of 84% was well within the 100% benchmark imposed for unusual values. IRIS Ratio 6 provides the yield in the company's investment portfolio over the past year. IRIS Ratio 6 is calculated as net investment income earned during the year divided by the average of cash plus invested assets over the current and prior year. The source of this data can be readily found in an insurance company's annual statement from the balance sheet and statement of income. The purpose of IRIS Ratio 6 is to identify companies earning unusually low or high yields, potentially indicating a risky, inefficient, or expensive investment strategy. Unusual values are outside of a 3% to 6.5% range. That is, it is expected that companies will achieve a 3 to 6.5% yield on their invested assets during the year. When reviewing the result of this ratio, consideration should be made for the cause by looking at each of the components of the calculation, and further investigation into the types of investment should be made. The following provides the calculation of IRIS Ratio 6 for Fictitious. As displayed in the above table, the result of IRIS Ratio 6 for Fictitious of 5% was right around the midpoint of the expected benchmark range of 3 to 6.5% for usual values. This means that the company earned a return on its investment assets within what would be considered the norm for companies in 2018. IRIS Ratio 7 is what the NAIC calls the ultimate measure of improvement or deterioration in the insurer's financial condition during the year. It provides the change in policyholder surplus, current year over prior year, as a percentage of prior year surplus, with the surplus figures coming directly from the company's balance sheet. We note that historical surplus figures are also provided in the 5-year historical data of the company's annual statement. Unusual values are outside of a minus 10% to plus 50% range. That is, a decrease in a company's surplus by 10% or more, or an increase by 50% or more, is considered a signal for the analyst to perform further inquiry and investigation. The NAIC recognizes that a 10% decrease is conservative. However, decreases in policyholder surplus are of course a greater concern than increases. Increases in surplus of 50% or more are very unusual for a stable company, absent an acquisition or redistribution of capital amongst affiliates, and therefore would be a sign of financial instability. According to the NAIC, a number of insolvent insurers report dramatic increases in policyholder surplus prior to insolvency. Using the 5-year historical data exhibit, we can calculate the result of IRIS Ratio 7 over the past 4 years. As displayed in the above table, the result of IRIS Ratio 7 for Fictitious did breach the minus 10% mark for unusual values in 2017 at minus 12%.